Hello everyone, and welcome to this InvestSMART webinar today with me, Alan Kohler, and Alastair Davidson, who is the head of funds management at InvestSMART. And this webinar is entitled The Anatomy of an ETF, in which we'll be explaining how InvestSMART chooses and manipulates or looks into ETFs, how we go about it. And Alastair is going to explain that. So let's get straight into it. Alastair, over to you, and I'll moderate along the way, I guess. But you've got some presentation slides to deal with. So,
yep.
G'day, Alastair. Let's go.
Thanks, Alan. Thanks for the introduction. Welcome, everyone. I think, as Alan pointed out, this is called the anatomy of an ETF. We cover a number of things here, and I think on the next slide, it's basically how we select ETFs. What's the basis? How do we analyze ETFs to pick the best ones that are the ones that we think are the best ones to go into the portfolios that we run? How we construct the portfolios? What other metrics do we look at when we're looking at ETFs? And also to introduce what we've just added to our professionally managed account service is you can now add custom ETFs. So you can, rather than us picking the ETFs to go in your portfolio, you can choose from a limited selection of ETFs if you've got a personal preference for a particular asset class or a particular ETF. So if we go on to the next slide.
If I may say, that's a fantastic addition to the InvestSMART service, really, because it's it adds a real personalised note to the whole thing, and I'll be looking forward to you explaining how that works.
Thanks, Alan. No, we've had a number of investors ask for this, and it's just part of the evolution of the service that we're trying to offer, trying to give people as much flexibility with guidelines to make their investing simpler.
So let's do some basics of what is an ETF and how does it work.
Well, typically ETFs. The simple thing is ETFs are just unit trusts. They're managed funds, and the managed fund industry has been around for 60, 70 years. And what's happened in the last 20 years is that rather than you applying for a managed fund through signing bits of paper and filling in application forms, what the industry has done is you can now buy effectively managed funds on the stock market, on the ASX. So you can go to your online broker, click a button, and you can buy it, and click a button, and you can sell it. So it's made it much easier for people to buy managed funds. So they trade like stocks. So like BHP, you can click on the buy to BHP, or you can click on it to sell it at a price that you choose. What this has done, though, it's made the whole managed fund industry, covers assets like shares, bonds, commodities, properties, esoteric assets, life insurance policies. You can buy off funds that invest in all sorts of things. And it just makes it easier for individuals to go and buy those funds without having to, as I said, fill in lots of paper. It takes 2 weeks, to buy a fund. It can take 10 days to get your money back from a fund. If you buy it through the ASX, it takes 2 days. You can buy it, you've got it the same day, or it settles in 2 days. If you sell it, you've got your cash back in 2 days. So it's just a much simpler process. And what ETFs then offer is, if you like, say, the US share market, or you like small gold miners in Australia, rather than having to go and pick which is the best gold mining stock, you can buy an ETF that effectively buys the whole of the gold mining sector. There's one, VanEck has a gold mining share company ETF that's got 80 shares in it. So when you buy that, you're effectively buying all 80 companies that are listed on the ASX, which would be hard to do if you tried to do it on your own.
Very, very hard to do.
Yeah. So I think what ETFs have done, and so that's in simple terms what exchange traded funds are. And what they've done is they've made it simpler for people to buy into a lot of different investment strategies and different asset classes. Because, if you've got an online broking account, and today you can it takes about 3 minutes to set up an online broking account. once you've got the money in there, you can buy whatever you want almost. There seems to be no limit to what you can get.
Before you move on to the next slide, Alastair, I probably should tell the audience that you can ask questions. That we're having a Q&A session at the end, but also if we'll kind of drip questions in as we're going along. If you have any questions, also Mitch Datson is standing by he's also answering questions on the chat as well. So you can put the questions into the chat. Mitch will answer them. We'll also perhaps choose a few to answer as we're going along and also at the end. So back to you, Alastair.
Thanks, Alan. So if we turn to the next slide, I mean, that's a summary of what ETFs are. So as I said, there's a wide range of strategies and asset classes, but there's sort of two broad categories that we look at. So there's the index ETFs. So those are the ones that track the ASX 200 or the S&P 500 or, the Bloomberg bond index, or, there's a real estate index that you can track, or as I said, the small gold mining companies listed on the ASX that you can track. Those are ETFs that will buy all the constituents of the market. So if you buy an index ETF issued by, say, iShares, IOZ, it will have 200 shares in that unit trust. And you're buying a portion of those 200 shares when you buy an ETF that's listed on the ASX. Now, what index ETFs have is, they've got low fees. I think the IOZ is down to 5 basis points. There's an S&P 500 issue from Vanguard that charges about 3 basis points. So that's 0.03% of the asset base per annum. So it's very, very low cost. And what we say to people with index ETFs is that's typically what you should be building your core portfolio with. So if you've got, $100, you should have $70 to $80 in index ETFs, because they will track the market. They will give you an outcome that's probably as good as most active fund managers, in fact, probably better. I mean, what we've done and all the analysis that we do and what the analysis that, say, S&P does, is that most fund managers, active fund managers, underperform their benchmark index. And partly that's because they've got trading costs, and it's partly because they charge higher fees than 3 basis points. And, if you think about it logically, it's very hard for fund managers to outperform. If there's one outperforming, there must be one underperforming. And it does become a sort of zero-sum game where it's the fees that make the difference. So we always say, go with a low-cost provider, go with an index tracker, because, for most of your money, because that will give you probably the best outcome. On the other side of the coin, obviously, there's now thematic ETFs and active ETFs. Thematic ETFs are the ones that say that will track, lithium stocks. So BetaShares, for example, has a whole bunch of ETFs that will track, electric car manufacturing companies. So they create an ETF that's got the Teslas, all the companies that make electric cars in the one ETF, 20 to 25 stocks. You can buy that if you think electric car stocks are going to outperform. As I said, you could buy equal weighted indices. So there's VanEck has a market, an equal weighted ETF. So they take the 200 shares in the ASX, and they buy 0.5% in each one. So effectively, you've got all 200 companies, but rather than being market cap weighted, which is what an index would do, they've only got 0.5% of their money into, say, Commonwealth Bank, rather than 11 or 12%, which is what you would have if you had a market capitalization index. The other side of the coin is there's now what they call active ETFs. They are essentially what active fund managers have sort of realized in the last 5 years, that it's much easier for investors to buy their funds through the ASX. So if you've got a managed fund, and Perpetual's done this, and Colonial First State has done it, and all the major fund managers, Magellan, they've all realized that it's easier to have a unit class in their fund that's listed because there's a lot of people, as we said earlier, who like using their online brokers to buy and sell, because again, it's the click of a button. It's very easy to do. So you've now got on the market probably another 100 to 150 exchange traded funds, which we would call active exchange traded funds. InvestSMART, we have 4 that we have listed under the Intelligent Investor brand, and they're effectively an easy way to buy managed funds. But they're the same as the unlisted managed funds. You get the same experience, the same risk reward outcomes, but it's just a simpler process to buy and sell. So what we say is, in terms of using these, thematic and active ETFs, is get the majority of your portfolio into an index, 70 to 80%, and with the balance, the 20% that's left, then you can pick sectors that you think are important, or you can pick active managers that you think might outperform. There is a lot of analysis that you can see on whether active managers do outperform. Sometimes they outperform bond indices because, there's a little bit of, they sometimes have an information edge. Trouble is, it's not a persistent, over 5 or 10 years, it tends to dissipate that advantage that they have. Even small company funds, which you would expect small company managers to have a better chance because they're doing a lot more research. There's less publicly available research in small companies. But again, they do outperform at times, but over the long term, they do tend to drift back to below the index. And but if you have a theme and you've got a theme that you think is going to work, like buying gold, for example, so that's something you can do now with thematic ETFs.
Just back to equal weighted ETFs, why would you do that rather than invest in a market weighted ETF? What's the thinking behind doing that instead of of an index, a fully market weighted index one?
Well, Alan, there's been a lot of talk that Commonwealth Bank is probably the best example of where there's a lot of industry talk in the press where the price of Commonwealth Bank has been pushed up because index funds are buying it. So you may say, well, I think the ASX is a good place to invest, and I'm still not sure what companies to invest in. I haven't found a manager that I think is going to be active. If I buy an equal weighted index ETF, then effectively I've downplayed the size of Commonwealth Bank in my investment. So you sort of take a view of the top stocks, and some people have the same view about the US. The Magnificent Seven, and if you look at what the Magnificent Seven have done over the last 4 to 5 years, probably 70% of the performance has come from those stocks. So you may have the view that may not continue. So why would I buy an index market capitalization weighted index that's still got most of the money in those top 7? If I buy an equal weighted one, I'm sort of downplaying the size of those investments. And
I suppose what you're saying is that you think that the smaller companies in the index will outperform the bigger ones from now on.
Well, that's right. Yeah, that's the view you can take. Now, essentially, we've done some analysis on the market weighted versus the equal weighted ones. The performance is actually pretty similar. It's between, over the last 5 years, you would have got maybe a 1% outperformance with the market cap weighted one. So it's interesting that they haven't actually outperformed or underperformed particularly. So you say that they work, and you can see the logic behind it, but it's still probably true that index market capitalization index ETFs typically perform the best in all sorts of markets. But we haven't had it. Sorry, Alan.
No, go on.
No.
You haven't had it. I was just saying there's a question from Jocelyn Lee, which is worth asking. She says, is an index ETF a better investment than a thematic one?
Well, to answer Jocelyn's question, it depends what you're trying to do. I mean, what we're looking to try and help people who are investing for the long term. And, we're typically dealing with people who have a self-managed super fund or who have, money outside of super, but have a longer term view. And we always say you're better going with an index ETF. And it's then important to pick whether you want to be in high growth assets like equities, or you want to be in defensive assets like bonds or property. You could buy a thematic index like gold, for example, but apart from the last 3 years, gold had done nothing for probably 10 years before that. So you could buy a gold ETF, so it holds physical gold, but would that be better than an index ETF? It will outperform over time, but if your investment strategy is to try and create wealth over the long term, you want to be in index ETFs.
Okay. That's good.
That's good. Yeah. So if we flick over, I think. So the basis we select, we have 5 major criteria that we look at to try and to pick the best ETFs that we use in our portfolios. And this chart effectively explains the different 5. Now, size is important because you want to make sure that the fund is sufficiently large that the manager or the issuer is making enough money to keep the fund going. There is an issue if a fund is too small, and it could be performing really well, but if it's too small and the costs of running the fund are more than what the manager's making, they will close. And Peter Shares is a very good example of that. They close 10 to 15 funds every year just because they haven't reached critical mass or they've not been as popular as they thought. It's not a problem. You don't typically lose money, but you do have this problem that you're giving your money back, perhaps when you don't want to get it back. You then have to find something else to invest in, and it can crystallize a capital gain because they're cashing you out when the fund's gone up, say 10%. You get your money back when it's 10% higher when you didn't particularly want to. So we tend to go with large, big funds because we know that they're going to be around for quite a long time. Liquidity is the other one. It's just, how easy is it to buy and sell? The beauty of index funds is typically they're as big as the market underneath them. So if you look at the ASX 200, it's almost $1 trillion market. It trades, tens of billions of dollars every day. If you wanted to buy $1 billion of an index fund, you could do that today without probably moving the market very much. But if you're buying $1 million, and we can buy and sell 10 or $20 million on a day, we know that we can buy and sell it without moving it particularly. It's liquid. Obviously, as you go down the market sizes, if you go to the small cap market, it becomes slightly harder. There's a constraint if you buy into assets that are sort of illiquid. Let's take Bitcoin as an example. Bitcoin is a difficult one because nobody knows how much trades every day. It's not a very visible market. So you never know if you're buying $1 million or selling $1 million, does it actually move the market? The third one's tracking error. So this is probably a more important one. If you're trying to get the returns of an index, you want to make sure that the ETF actually follows the index, and it's day to day there'll be small movements on the bid and offer as the markets move, but over the long term you want to make sure if the index is up 10%, your ETF is up almost 10%, less whatever fees it's charging over the same period. So that's an important one, and we look for tracking over 1, 3, 5, 10 years just to make sure that it does track on a regular basis. We're not too worried about day-to-day tracking. It's just making sure over the longer period it tracks well. The fourth one, I think we've discussed, the fee structure. That you get the index return less whatever fees you get charged. So the lower you can make those fees, the lower the transaction costs, the lower the management costs, the better, the closer you get to that index return, which is what you're trying to get. So that's probably one of the more important ones. And then the last one, which is the most important one that we look at, is the bid-offer spread. Now, just to explain to the watchers just what that means. If you buy BHP, so BHP will be, say, $40.10 today, will be the bid price, but the offer price could be $40.15. So you've got that 5-cent bid-offer spread. Now, on $40, 5 cents is 0.1%. So it's not much, right? But some ETFs have spreads that are 1 to 1.5%. So you want to make sure those spreads are reasonably narrow as to when you can buy and sell without having to incur too many costs. And that's the one a lot of people forget. They'll buy something and thinking, oh, well, I've got this. Obviously, the longer you hold it, the less important that becomes. But you want to make sure if you come to sell it, you're not paying brokerage plus a big spread. The best example are the cash ETFs, like the AAA that BetaShares has issued, or the BILL, which iShares has issued. They typically have a spread of 0.01%. So you can buy and sell those relatively easily without incurring too many costs. So those are the 5 factors. We weight them differently, but typically we go for the fee structures and tracking error and the bid-offer spread. That's the main ones, and it's tracking over a longer period. So I think, Alan, if we want to move on to the next one, unless there was a question that was coming up. There's a question here from George Moskos, which I can answer. All ETFs, well, just to answer George's question, just how ETFs, and this is more index ETFs than active ETFs, there's usually a market maker, and it's usually a big bank. For our ETFs, our active ETFs, we use Citibank. So there's Citibank, there's Deutsche Bank. So all the ETFs have market makers, and the market makers will make a bid and offer price in the screen all day. Now, the size depends on which market maker you're using and what sort of index that they're looking at. We have 100,000 units on the bid and offer all day for our funds. If you look at those cash ETFs like AAA and BILL, they, I think, have 500,000 units, approximately $4 or $5 million on the bid and the offer all day, every day. So the market makers are there, but again, the bid offer spread is usually determined by the liquidity of the underlying assets. So you can have bid offer spreads that are wide. We've seen funds, which have a bid offer spread that's, 1% or almost 1.5%. Those are the ones you've got to be careful, because, it's an extra cost to buying and selling. The market makers will make the market as close as they can, but there's always a spread. And it really depends on the assets and what sort of fund it is. So, Alan, if we go on to the next slide. So this is basically how we build our portfolios. They're all designed to, suit a different risk profiles. We have, the normal range of, conservative, balanced growth and high growth. We've added ethical growth and ethical high growth, for those, because there's such a wide selection of ETFs. You can construct a portfolio that just looks at ethical ETFs effectively. So these are ETFs that are rated by RIAA, the Responsible Investing Association. So we know they're ethical, but you can construct a portfolio that's got equities, bonds, property, which is fully ethical. We use long-term, as the slide says, we've got long-term investing principles and an investment committee that has, a number of prominent people on it. Our research, we tend not to change our portfolios very often, because one of the things that detract from your performance is obviously transaction costs. And if you're buying and selling different ETFs, you can crystallize capital gains for your investors, or you can lose some performance because of the bid offer spreads and the switching costs. So typically we tend to find the lowest cost providers of an index that we want to invest in, whether it's international indices or domestic indices, and we tend to stick with that one. When there's a cheaper one that comes around, we do a lot of analysis to make sure that we don't crystallize capital gains for the investors that are currently in there, because we could switch from an ETF that's got, say, 5 basis points in management fees to one that's got 3 basis points in management fees. But to save 2 basis points, we don't want to crystallize tax for 80% of our investors, and the cost of, for them to lose money in tax would be a worse outcome. So it's better to stay invested, to not transact very often, and to stick with the asset classes you've got. We do adjust our portfolios on a quarterly basis. We tend to stick with the typical asset allocations across equities, growth assets, and defensive assets, across international assets, international equities and domestic equities, international bonds, domestic bonds, infrastructure, and property. And we rebalance to make sure that we're tracking those benchmarks, we use the Morningstar balanced growth, high growth indices to make sure we're tracking those benchmarks that we've set ourselves as closely as possible without creating too many transactions. And the last one that's important to making sure we do meet those targets of targeting those benchmarks that we're trying to meet or outperform is to make sure we don't charge too much in fees. So the most important thing, which Paul Clitheroe, our chairman, has said, and Alan has mentioned as well, you can control your costs. You can't control your outcomes, but you can control your costs. So it's very important to make sure that you don't spend too much money on fees, you don't spend too much money on transaction costs, and that gives you the best chance of getting an outcome close to what you're expecting. I think Alan, your sound's still missing, but a few technical problems. But let me continue. If we flick on to the next slide. So at the end here, I just wanted to introduce Custom, because I think this is a new feature we just introduced in July, beginning of this month. We've been working on it a while, and it's driven by a lot of investors who want to see this. And I've used it. I think it's actually great what we're doing here. So we've got our basic portfolios. We've got the balanced, conservative, balanced, growth, high growth, ethical high growth. We've also got discrete asset class portfolios. You can buy international equities. That's a portfolio of 6 ETFs. You can buy a bond ETFs, a bond portfolio that's got 2 ETFs in it. You can get a cash securities one. What we've done here is you can now add your own choices to this to our portfolio management service, and that is coming from a list of about 80 odd ETFs, which we've sort of curated this list from the best ones using our 5-star rating process. And the rating process is based on something I talked about earlier, those 5 key criteria that we use to pick the best ETFs. But the custom service now gives you the chance to add something that you think, a theme or an active ETF that you think might outperform, or you just want something that you think you have a view on to come into it. So you can add up to 5 ETFs. They sit in the same portfolio management account, so you get the same tax reporting. You can see them through the portfolio manager service. You can see what's there. The transaction costs, it's the same cost structure, so you don't pay anything to buy. The same management fees and admin fee are there, but the management fee is capped. So obviously, if you've got more than $200,000, there's only the admin fee to pay. So it's a very low cost way to add, your choice of ETFs. It just gives you the chance to personalize your own account. That you can say, well, I'd like a bit of gold. I'd like a bit of some extra high yielding Australian equities, or I'd like a particular sector of the US market, and I can add it in. So on our website there is a list. That list gets updated every month. We'll look at it, and if there's requests from investors to add to that list, we will add new ETFs. And typically we'll review the whole list every 3 months and add more. And we intend to add more ETFs to this thing, because so far it's been fairly attractive to most of the investors. So if you flick to the next slide, this is something that I've done. So in mine, I've actually added two gold ETFs to mine. There's the the one that's issued by ETF Securities, which owns physical gold, that has trades effectively in line with the gold price. And there's another one that I added, which is issued by the Perth Mint. The reason I added that one is it's actually guaranteed by the WA government. So you've got that security of knowing that the WA government is going to make sure that the gold is always there to make sure that my ETF actually delivers if I ever want to cash it in. But on the list itself, there's VHF. There's which one of there was a question earlier on that gives you access to the high yielding stocks on the ASX. There's an MSCI one from Vanguard for small companies. Again, it's this is another way that you can track an index of small company stocks. But there's a whole list of it of about 80 odd additional ETFs that you can add there. So it's simple to do. You can add up to 5, a minimum of $2,000 for each one. But it's a very simple process just to add another one. And, at the low brokerage rates that we've negotiated with our broker, $4.40 or 4 basis points, it's hard to find somewhere where you can get them cheaper. So on the next slide, I think there's a process there for new investors. For those of you that don't have a PMA account, if you go through the application process, you are required to have one portfolio before you can buy custom. And as I said, you can buy a cash portfolio or international equities or a balanced growth or high growth. And then on that application process, you can add a custom ETF or up to 5 custom ETFs as a very simple process. If you're an existing investor, it's quite easy. Just log into your account, navigate to the menu to choose add funds or modify your allocation. And you can see all the choices of ETFs there. There's a drop-down list of everything that's available. And as we said, if there's things that you think should be there, please contact us, email us, and we will look at adding them on. And we hope to have an investment committee in the next 3 weeks where we will add 3 or 4 additional ETFs to the list that we currently have. And I'm sorry about Alan not being here at the moment, but let me just see if there's any particular questions. I've got an access to the questions down the side here. I'm not sure if there's any that are. There are. So there's a question there. Do ETFs allow for reinvestments? ETFs do. Typically, we don't reinvest directly into that ETF through our portfolio administration service because we have a number of investors who take income out. And also we want to sometimes rebalance. When you want to rebalance your portfolio every quarter, we tend to collect the money and rebalance once a quarter. Now, the benefit of that, it lowers your transaction costs, sort of minimizes anything that may be, it makes sure that you're investing with a reasonable amount of money so that $4 contract note cost doesn't become excessive if you're only buying $200 worth of an ETF. But effectively, you are getting the best of investing at a low cost into the right assets. There's another question there. Do we have an issue sourcing fixed income ETFs? If you go on our website, you can look for and search for fixed income ETFs. There are categories there. We are in the process of updating our ETF report. It should come out in the next week or so. The 2024 report is on the website, but the 2025 one will be available very soon. And that ranks all the index funds that do fixed income on there, gives them our 1 to 5 star ratings with the rationale as to which ones we think are the better ones, and it gives them the most recent performance numbers. So Lee, if you wait for that one to come out, you can see which ones that we're recommending.
Hey, Alastair, can you hear me now?
I can, Alan. Yes.
Hooray.
Great to
Well,
hear you.
that took a bit of effort. I don't know what happened there. Anyway, sorry about that. Not that I'm vital to it. You're the one conducting this webinar.
No. It's nice to have you there. It's your insightful questions.
Well, it's nice to be here. Okay,
so I've answered a couple of questions, and let me just go down and see if there's something else that was.
Where are we? Have you finished the webinar now?
Well, we're down to questions. Drop in the questions.
Okay, good. Right. Well, there's tons of questions. Tons of them. Look at them all.
Tons of questions there. There was one from Xian. Please advise what specific ETFs we've selected based on our criteria.
Okay,
Xian,
do that.
Just to answer that question, obviously, as I just mentioned, we've got this ETF report coming out. All the ETFs that we pick in our portfolios are 4 or 5 stars, right? So we don't usually pick anything else other than that. In the custom portfolios, it's 3 stars and above. You can pick any of those ETFs. We have a couple of criteria. Again, we've limited the list to ETFs that have more than 500 million. Now, ETFs are growing every day, so the ones we picked 3 months ago at the beginning of April are now probably the ones that were just below 500 are probably through that now, so there'll be another list. But we use those criteria which I started the presentation with. That's what we pick them on. And if you look at our website and you look at this report when it comes out, or even look at last year's report, you can see the ones that we've selected based on the criteria that we use and the weightings that we put on those particular issues.
Did you see the question from Joe Sands? He says, if I invest 500,000 and have 5 ETFs, what is the fee? Only admin at $99 or $99 for each ETF?
So 500,000
and 5 ETFs.
And 5 ETFs.
What's the admin?
The admin fee is 11 basis points on the 550,000. I'm just going to try and work that out in my head, which will be about $500 per annum. And then there'll be a management fee, which will be capped at $880. So your total fee, Joe, would be about $1,300, 13 right. Something, including GST. Yeah.
Okay, that's good.
And then again, just to answer, to clarify for Joe, there'll be no brokerage on the buys. So you would buy those, you would spend $500,000 at nil brokerage. So there's probably quite a big saving there.
Yep. Zoe Brown says, do investors with InvestSMART have full legal ownership, or is their investment held under a custodian model?
Zoe, thanks for this question. You have full legal ownership. So we use a HIN model. So for those of you that don't quite understand how the ASX works, there's 2 ways you can hold shares in ETFs. One is under an SRN number, a share registered number. So that's where you own the shares in your own name with your address, but you've got a unique number. And then there's a holder identifier number, which is a CHESS-based thing. Again, securities are held in your name with your address and all your details, but that HIN number is linked to a broker. And we have a particular broker that you're linked to, but what that means is that we can give you very low cost brokerage to be able to buy and sell those securities. So you have full legal and beneficial ownership. Under a custodian model, you would have the beneficial ownership, but it would be held in the name of some nominee. So that's a significant difference between us and some other providers.
Nigel Rose has got a question that Mitchell Datson's answered, but maybe you'd like to answer it too. Nigel says there are ETFs in the custom list that are rated poorly by performance compared to their peers in the index on CommSec. Why are those on the list? IJR, for example, is in the bottom 20% by performance over the most timeframes.
Yeah. All right. Just to Nigel, it's a good question. We're looking at performance. Performance depends on what index that you're trying to buy into. Now, IJR is the Japanese index, which is probably underperformed because of currencies and various other issues that are going on within Japan. It's had recently quite good performance, but it's not. We're looking at it in terms of its fees, in terms of its index tracking ability, in terms of the size of the fund. So we think that one will perform against the index that it's trying to represent, which is the topics, as well as any other index, but probably with better fees and with a larger fund size. That's why we would have picked that one. But I'd be surprised, how many, there's not that many Japanese indices. An IGR would be, there's probably only about 4 of them that track, and it depends which index you're trying to track. There's 2 indices in Japan, and we tend to go with the larger index, which is the topics one, rather than the Nikkei.
Clive says, why don't you invest in investment trusts?
Investment trusts, there are a lot. We have looked at some private credit investment trusts. Now, the only issue that we have with investment trusts is there is no market maker. So you're buying and selling trusts, which are very much dependent on whether there's other buyers or sellers around in the market. And investment trusts tend to trade a bit like LICs, listed investment companies. So they can trade at discounts for quite a long time. So you can buy them, and you are usually buying assets at a discount, 5 to 10%. The problem with trusts is that discount can stay at 5 or 10% or get bigger. So you don't necessarily get the performance of the underlying assets. You get the performance of the trust as it trades on the market. And the difference being, if you buy an ETF, you get the performance of the index, because there's people creating units and canceling units all the time. So there's never an overhang of buyers or sellers. You're only buying the market at the market price. So that's why we've steered clear of listed investment companies and investment trusts.
Okay. A couple of people have picked you up on the IJR as US small caps, or S&P 500.
Oh, I'm sorry. Sorry, I was looking at IJ. Sorry, I misread that one as IJP.
IJR.
IJR
is US small caps.
Small caps, I beg your pardon. That was my fault. I was looking at it. I have to get my glasses cleaned, I think.
Okay.
IJR. Let me take that one away. The IJR index. I'm trying to remember off the top of my head which US small cap index that comes back to, but rest assured I will answer those questions. As soon as this presentation is finished, I will do a little bit of research to find out just why that one has underperformed, because I'm not sure which small cap index that follows in the US.
Apparently the S&P 500 small caps, or S&P small caps anyway.
The S&P small caps. Yeah. I'm not quite sure why it would be underperforming any other or any other S&P, any other index ETF that was following the same index. It should be performing the same. It's usually an index difference. I mean, there is the Russell small cap index in the US, which would give you a slightly different outcome, obviously.
Nick says, how do you protect against a major market fall? Which I'm not sure you can really, but anyway, go on.
No, I've got to say, Alan, I was going to let you answer this one, but it's we can't. Now, I'd love to say we have the best crystal ball in the world, and I would probably, if I did have it, I would make it cleaner than my glasses so I could see what was happening. We don't have that. So if there's a major market fall, all we can do is say that a lot of our balanced and conservative and growth portfolios have a mix of defensive and growth assets. And, it's the old 60-40, 70-30 rule. As long as you don't have all of your eggs in one basket, you should be cushioned from a major market fall to some extent. Now, that said, during the GFC, everything fell in unison. If that happens again, all I can say is it will happen again. We just don't know when.
Yep. Archie says, by offering a targeted and specific list of ETFs that are star rated, does that mean we're more likely to do better than an investor in, say, beta shares direct that can choose any ETF for their custom type account, custom type option. So really, I suppose he's asking for just a comment about the benefits of having a walled garden of chosen ETFs for to choose for the custom ETF, I guess.
Yeah, look, I think, Archie, it sounds like you're obviously a more sophisticated investor. What we think, we have a duty, an implied duty, to make sure that our clients don't get themselves into trouble by piling in or buying into the wrong thing. One of the reasons we haven't added Bitcoin so far is it's quite volatile, and we would want to make sure that people had a limit on how much Bitcoin or a Bitcoin ETF that you had in your portfolios. So we think we're trying to do the right thing by investors. I think, Archie, at some point, we will open up this platform to let you invest in anything. It's early days yet, as we've said. We'll add more ETFs as we go along, but we do have a belief that for most people, there should be guardrails of some sort to try and stop them saying, well, I'm cashing out all my money from my conservative portfolio and putting it into Bitcoin, because that's not necessarily in the best interest of the investor. And we don't think we wouldn't have done the right thing by the investor if we let them do that without some guidance or guardrails.
Louise wants to know, if we don't have an account with InvestSMART, are we able to access the STAR report for ETFs?
Louise, you can, if you leave your email address or log into our website and get in touch with us. We will send you a copy as soon as it comes out.
There we are. Good for you. Andrew says, in industry super funds, they offer thematic and active style options. Have you ever investigated their performance?
We do get, Andrew, we get a lot of data, which we spend a lot of time analyzing on what other people have done and comparing ourselves. The industry funds don't provide as much data as some of the other public offer or other major public superannuation funds in terms of what their asset allocations are. To the extent we get it, we do look at what they hold. So we look at what all the major funds which have balanced active high growth options, what asset classes are they investing in, and how much and how often do they switch them? Because that's probably quite important. Where is the money moving to is more important than where it's been. So we do. We are looking at doing different reports. It's an interesting topic, that, Andrew, and let me take that on board, because we should do a report on what major super funds do, and how do they manage superannuation money, and what can you do to try and replicate what they do at a low cost. We're of the belief that you can actually replicate what Australian Super does in their balanced growth and high growth options with about 5 or 6 ETFs. You can do exactly what they do at probably the same or less cost.
The questions are slowing up, but Joe says, comparing growth funds to VAS ETF, VAS has 8.79% total return and 4.48% income versus growth ETF. And why is choosing an ETF from InvestSMART better than that? And the VAS has 0.07% fees.
0.0%,
yeah. Why is choosing? So look, I mean, there's an opportunity for you to pitch the InvestSMART difference. Come on.
No, I do. Well, obviously, Joe, you can buy individual ETFs and you get a tax report. What we think we offer is we've got a number of other tools and things that you can use. We have health checks that you can add. You can add your portfolio to our system, and we'll tell you whether you've got enough assets in the particular asset classes that you want. You know, you can, if you think you're a growth-based investor, have you got 70% of your assets in growth and 30% in defensive assets. So we give you all those free tools when you come on and use our services. You know, Vanguard is a great service. They're a great provider and an excellent issuer of ETFs, and we use a lot of their products. We think that if you come to InvestSMART, we can give you a lot more help with making investment decisions. You know, we're agnostic to any ETFs. You know, if you go on the BetaShares Direct platform, they tend to push the BetaShares ETFs at them, which is what you'd expect. If you use Vanguard, Vanguard tends to offer you what Vanguard offers you and no one else's. We will look at everyone. We're issuer agnostic, as I said. So yeah, you may suffer some small performance because you're paying us a fee for that, but we think we can add value in other ways.
There you go. We seem to have run out of questions, Alastair.
Hopefully I've answered them all right, or maybe nobody likes the answers.
No, it's good. I think you've been comprehensive.
It's quite comprehensive, right?
Yep. So I guess that's it then.
Yeah, well, I think this is recorded, so I think just to say that we will be sending this out to everyone who attended today, and there'll be a copy available tomorrow, I think, according to Mitch. So
on the website.
On the website, yeah.
Yeah. Okay. So yes, Joanne, it is recorded, and there'll be a replay of it for whenever you like. Joanne says it's brilliant. Thank you very much.
Yep, that's great. Okay, thanks, Alan. Thanks for hosting that. I'm sorry
thanks everyone
you went silent for a bit, but it's nice to have you back.
No, it's good to be back, and thanks everyone for participating in today's webinar. It's been great to have you, and I hope you learnt. If there's any questions you have, please feel free to call up the customer helpline at InvestSMART, or email them, and we'll be fine to answer your questions. So see you later.
That's great. Thanks, Alan.